as petrochemicals. We achieved this on the back of higher volumes, better margin environment, as well as operational excellence. For refining, with a gross refining margin of $12 per barrel, we saw a 9-year high. For our petrochemical business, with EBIT margin at 17.7%, we saw a near 10-year high. For our consumer businesses, we had almost off-the-chart growth in revenue from our retail business, with revenues exceeding 14,000 crores. We are by far the largest retailer in India, as we know. And for Jio, the debut financial results show positive EBITDA as well as positive EBIT, beating all street expectations. And we had a subscriber base as of September 30th of nearly 139 million subscribers. As an update on projects, our cracker project has started up and is being stabilized. As far as paraxylene is concerned, all the 3 trains have been commissioned. In respect of the ethane project, ethane cracking has stabilized at Dahej and Hazira, and our gasification projects are now under startup. Let me share with you our consolidated financials briefly. We crossed 1 lakh crores in revenue in this quarter, up nearly 12% quarter on quarter. PBDIT for this quarter was nearly 18,000 crores, up nearly 22%. Depreciation was higher by 41% at about 4,300 crores, and interest costs were almost double at 2,270 crores. When we look at the turnover, we were fortunate to get volume growth across all our segments, across refining, across petrochemicals, across retail, and of course Jio. The EBITDA and EBIT growth is on the back of a higher GRM environment, a better petchem environment, growth in Jio as well as in retail. Depreciation and interest costs are higher simply because we have now consolidated the Jio results into the company. Return on capital employed has improved again. Consolidated return on capital employed is now nearly 14%. And if we take that only on the operating assets, we see a return on asset of nearly 32% for Reliance Industries Limited. Very importantly, capital expenditure during this quarter was just over 15,600 crores, nearly 9,000 crores lower than the previous quarter. As we have said before, we are coming to the end of our capital expenditure cycle, and we should start seeing a further improvement in return on capital in the ensuing quarters. In terms of the macro backdrop in which we operated, 2017 promises to be another year of strong oil demand growth, with current estimates at 1.6 million barrels per day. This is the 3rd year of growth of over 1.4 million barrels every year, and the early estimates for 2018 also point to a 1.2 to 1.3 million barrels demand growth. This is clearly reflecting in a stronger operating environment, and when we look at our refinery business, we'll talk about that in detail. Oil prices were slightly higher. Brent was about $52 per barrel. Gas prices remained roughly flat at about $3 per million BTU. Exchange rate also flat at about 64 rupees to a dollar. And as we look back at the year, demand for petrochemical products was varied, but was relatively soft, between 2 to 5% across various products. Oil demand growth for transportation fuels overall was also in the 4 to 5% range, but we saw strong demand growth in diesel as well as in gasoline. Let's look at the specifics of our refining business now. Record EBIT of 6,621 crores in this quarter. GRM at $12 per barrel, the highest in 9 years, outperformance with respect to Singapore complex of about $3.7 per barrel. As far as products were concerned, we saw better cracks in gasoline. Margins were up nearly $2 per barrel from $12 to $14. As far as diesel was concerned, we saw margins which were nearly $2.50 per barrel better from 11.4 to 13.9. On the other hand, fuel markets and crude markets were slightly tighter. Broader Arab light, Arab heavy differential narrowed to just under $2 per barrel. Brent Dubai differentials were wider and fuel oil was stronger. So all in all, a better performance, strong tailwinds coming out of better product cracks, but some headwinds coming from crude costs. We processed 18.1 million tons, almost a record in this quarter. Oil demand growth, as I said, was between 4 to 5%. However, our own domestic petroleum business grew very strongly. We now have 1,260 plus retail outlets fully operational. As we look back over the year, the diesel throughput in our retail network is up nearly 50%, and petrol is up nearly 38% through our network. When we look at our refining business, we think that in the medium term, the continued growth in demand that we have seen for the last 3 years will significantly outstrip new capacity, and with reducing inventories, we have a fairly constructive view of the refining business in the medium term. As far as petrochemical business is concerned, again the highest ever EBIT at 4,960 crores, up 45% year on year. 10-year high EBIT margin at 17.7%. We benefited from both volume and margin expansion. Production was a record 7.5 million tons in this quarter, up nearly 15% quarter on quarter. Several of our products had significant margin expansion, and I'm listing just a few: PVC, MEG, staple fiber, yarn, as well as PTA. The integrated polyester margin went above the 5-year this thing after quite some time and was up 11% quarter on quarter. As we look ahead, clearly the full implementation of the ethane project and stabilization of the cracker will lead to a margin leg up in the ensuing quarters. In upstream, we had a better financial performance as EBIT was nearly 200 crores less negative than the same time last year. KG-D6 production was roughly flat quarter on quarter, even though there was a decline year on year. We started CBM production, and it is now ramping up slowly, but we expect to achieve a good exit rate by March 2018. Shale gas production was down 3.5% quarter on quarter. We managed to sell one of our upstream interests, a partnership with Carrizo that we had for 7 years, for $126 million, plus higher receipts based on higher gas prices. The retail segment continues to do exceedingly well. As I said earlier, very strong demand growth, 81% growth in revenue, 100% growth in EBIT, Y on Y. We have the widest footprint of any retailer in India, nearly 3,700 crores across 750 cities, over 14 million square feet of trading space, over 4 million customers served every week, and over 120 million footfalls in Reliance Fresh and Smart stores during the quarter. We are growing in every segment and in every format in this business. And now it's my privilege to talk about the success of Jio and its first quarter results. Just from a financial point of view, we had revenue of 6,147 crores, EBITDA of 1,443 crores, and EBIT of 260 crores. But these numbers really do not tell the full story. And Jio today represents the world's largest and fastest growing mobile data network. We had nearly 139 million subscribers as on September 30th. We carried nearly 380 crores GB of data traffic during the quarter. Nearly 180 crores of hours of high-speed video were viewed on our network per month, making Jio the world's largest mobile video network. And voice traffic every day averaged at 267 crore minutes. These are staggering numbers. We have achieved this with the help of probably the widest reaching distribution network in India. We have thousands of Jio points and we are working closely with 1 million retailers. The cumulative smartphone population in India, base in India, is nearly 160 million. And with our subscriber numbers, you can see that we have a very large market share among all the smartphones in India. And as people buy new smartphones, we are getting the same rate of acceptance as we have seen in the last year. We are convinced that we have a strong platform for growth based on upfront investment in network, in distribution, and unparalleled customer value proposition. This success story, if I may say, has just started, and I look forward to sharing our successes and milestones in the future. Thank you very much.
Are we live?